Welcome back to another Federal Reserve Day. Today is going to be absolutely nuts because markets have started to they tried legging down there a little bit going into this Fed meeting. Now, I want to be crystal clear about my strategy going into this and through this, so I don't want there to be any confusion. Last week, I thought that whatever happened with earnings, the Fed would put gas to. So, we had good earnings yesterday. I think the Fed is going to ignite that on fire today. In other words, positively. Now, don't get me wrong. This morning and yesterday, I also said that I thought there would be a lot of volatility going into the Fed meeting. I'm going to be frank here. I thought we were going to have a bounce at the open, and then we would have some kind of sell-off before the Fed. So in other words, there would have been an opportunity to ride calls going into it. That did not work out. Instead, certain stocks, in fact, a lot of them kind of just bled out going into the Fed meeting. I think there's a lot of nervousness around this Fed meeting, and there really shouldn't be. Inflation's not a problem anymore. We're already seeing the jobs market roll over. Yes, the JOLTS report came in a little warmer, but it was driven mostly by government jobs, although Jay Powell could use that top line number if he wanted to. ECI came in lower than expected, ADP came in lower than expected, and we think this jobs report this week could end up triggering the SOM rule, which would be a recessionary indicator. And you know what? I have a feeling Jerome Powell already knows what this jobs report is going to look like. So I think within the next minute, we are not going to get a cut, but we're going to get a Powell that's either neutral or positive. I don't think he's going to perfectly tee up the September rate cut. I've been pretty clear about this. But I do think that what Jay Powell will end up doing is being neutral to bullish without teeing up that cut, so that way he doesn't rug pull markets. Because with good earnings, if Jay Powell ends up crashing markets, then you're just going to unfortunately force layoffs and force a recession. People say Jay Powell doesn't care about the markets, but markets have everything to do with the money supply. You can literally create or destroy money out of thin air. So we're about to get the Federal Reserve release here. Again, we are looking for no cut. And I'm going to read off the statement as it comes. So we got about 5 seconds to go. I'm going to pull up the cues on the minute chart for everyone. And here we go. No cut as expected. That is as expected. The policy was unanimous. We actually got the cues kind of neutral right now. Let's see here. Overnight interest rates unchanged, attentive to risks on both sides of the dual mandate. They said some further progress on inflation. June, there had been modest further progress. Risks on both sides, achieving employment inflation goal, better balance, big deal. We do not expect it will be appropriate to lower rates until it has gained greater confidence, so nothing's really changed here. Achieving employment inflation goals, move into better balance. Does not expect it will be appropriate to lower rates until it has gained greater confidence. We already expected this. I mean, there's nothing here. Economy continued to expand at a, quote, solid pace. Okay, so nothing here right now. Let's listen in to what CNBC has to say on it. But so far, this is pretty expected, pretty benign. We've got a statement that didn't change much, and we've got a no rate cut. Let's listen in here.
The statement notes an improved outlook on inflation, saying it has eased and remains somewhat elevated, adding the word somewhat. So they're less concerned, as you can see, with the inflation level. I said there's been some progress towards the 2% target, not just modest further progress. Guys, I'll leave it there with really it's a change in the balance of risks, I would say, from one where they clearly indicated they had their keen eye and highly attentive to inflation. Now they're watching both sides of the mandate. But I wouldn't say they guarantee a rate cut in the next meeting. They maybe just...
Yeah, this is exactly as I expected so far. This is no cut and no tee up. This is pretty typical. Let's actually look at the words here so we can see it. Recent indicators suggest economic activity has continued to expand at a solid pace. Job gains have moderated, and the unemployment rate has moved up but remains low. Inflation has eased over the past year but remains somewhat, that's a pretty key word there, somewhat elevated. And we're going to be looking for the redlined version here in just a moment once it actually comes out, once people's algos sort of run it. But what I'm seeing... never mind. Wow, dude, Nick T was fast. I bet you that was AI. That was really good. Take a look at Nick T's. So Nick T has it right here. Good job, Nick T. Nicky Leaks. Okay, so moderated. Job gains have moderated. That's suggesting that's softening. This is not a tee-up, but it is being neutral to positive, right? Positive meaning dovish here. The unemployment rate has moved up but remains low, okay? The next thing they say here is Kevin has a coupon code expiring today. Okay, all right, we already knew that. Inflation has eased over the past year but remains somewhat elevated. That's fine, that's totally reasonable, no issue here. Some further progress towards the 2% objective. So some are modest. I mean, there's going to be a debate over that. Modest, I feel like, would be like barely. Like if you had sort of a 50-50 line in a tug of war, modest would be like, it's like 55% over the line, right? And then if I said some, it'd probably be like 15-20% over the line. So I think some is more like a larger move. That would be my read of this. Inflation goals continue to move into better balance rather than have moved towards better balance. This suggests that there was a move and that move is now continuing, and so they got to be careful they don't go too far to cause unemployment to spike. Economic outlook is uncertain. Committee remains highly attentive and has changed that to committee is attentive. Oh, whoa, look at that. They got rid of highly attentive to the inflation risk, and instead they changed it to the committee is attentive to risks on both sides of the dual mandate. Oh, that's actually pretty juiced right there. That's pretty juicy right there. Hold on a sec. I want to write on that one. That's an interesting line right there. Wow, look at that. I call that a green shoot right here. Is attentive. So they have. This is the first time in forever I can, as far as I can remember, completely removed highly attentive to inflation risks. It's completely gone. That is a victory signal right there on inflation right there. They're not going to declare victory. I'm not trying to declare victory for them. I'm just saying that is huge. They're basically now saying, look, we're done. That's crazy because, see, like at the top, they're like, all right, we got to deal with inflation and jobs. Yes, we know that. That's your dual mandate. Which of the two are you highly attentive to? Well, we've been highly attentive to inflation. Nope. Now we're attentive to both. This is the first time in years we have seen the Fed go attentive to both. That's very, very, very good. Very, very bullish. This is my read. I could be wrong. J. Powell could talk this down and stuff. But again, I want to be very clear. I think that the market sold off going into this J. Powell presser because they think this is going to be a bad catalyst. Ironically, everybody was expecting the Fed to tee up a rate cut, but then there were so many people, myself included, that are like, dude, the Fed's not going to tee up a rate cut. I think we got too bearish about the Fed today. Like, people got way too bearish about the Fed today. So, I'm calls on it. I'm calls on the Fed day here. I'm calls on Powell, just being transparent. I have some longer term hedge puts still, but I am calls on this meeting, and nothing's changed over the last 10 minutes. I've said that even before this. So the question now is going to be Jay Powell. What is he going to say? Because that is a big change. If I was at the meeting, and there's no SEP today, so remember that, no summary of economic projections. But if I was at this meeting today, I would call this out. I would say, hey, this is the first time in, whatever many years. I would look it up. I don't have the patience to do that right now because I'd bore the crap out of y'all. But this is the first time, I might even just say in years, that you have not said that you are highly attentive to inflation risks. Instead, you've essentially said you are now equally attentive to both risks. Does this mean that we now have a 50-50 risk on inflation and a 50-50 risk on jobs? And frankly, that's the job of the Fed. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay, there we go. That is the job of the Federal Reserve. The job of the Federal Reserve is to make sure that both risks are balanced. So I think somebody's going to ask the question. Someone will ask Is inflation and the jobs target now an equal priority? Never. They will. He'll probably also say we are not declaring victory. Not declaring victory. Okay. In the middle we'll go with Jerome Powell is on time. I think that one's pretty typical. I'm gonna write on here that I think stocks end up higher. Stocks rally during and after Jerome Powell speech. My take, it's my guess, could be wrong. Not financial advice, bro. Okay, so we're gonna go with. Let me see quickly what the suits are saying. 2-year yields have ticked higher. That's not good. That's more inversion. Hold on. I want to quickly see the bond market reaction. 10-year ticked higher, and so did the 2, I believe. You have 2 ticked higher. A little more inversion. Yeah, you're at about 25 basis points inverted right now. So you inverted a little bit more after that statement came out. That is a recessionary flag. Remember, when we have the yield curve steepen, or I shouldn't say steepen, further invert is actually the correct phrase. When that occurs, the market is saying we might be closer to a recession. Now, we did not see recessionary indicators in the earnings reports of the last, week. In fact, even Google's earnings reports, even though there was a sell down, a de-risking after Google's, they indicated that they were going to continue hiring at a modest pace. I called that out as we read the earnings report. I said, this is good. That is not recessionary. You could go back and watch the videos. I've been very consistent with that. My concern obviously has been that earnings would be bad this cycle. So far, yesterday and today, earnings have been broadly very good. And it has removed a very large chunk of the concerns that I had going into this week. I was really maybe overly concerned about this week's of earnings. Okay, that happens. I'm definitely not always perfect, that's for sure. But we are now 21 minutes away from getting JPOW. And I just want to say, after the FOMC statement, yields, let's write this down, Fed, there we go. Okay, after the FOMC statement, yields inverted more, 210 now, negative 25 BP, likely flagging recession risk due to Fed equalizing the risks between inflation and jobs in the FOMC statement without propping up a September cut. Now, that's broadly expected that they would not prop up a September cut. I'm going to say that. So I'm going to say expected no September cut prop up, but did not expect removal of highly attentive to inflation risks, thereby balancing jobs versus inflation. I did not expect that. That is more dovish. And again, this is my opinion, so I'm going to give you some opinions from the suits here. Okay. Nick T, let's see here. I want to see if he made any comments on it. I will. Let's see here. Nick. And then that'll also inspire me to put together some more bingo. Quote tweet. Did not expect removal of highlight. This now equally balances jobs and inflation. 50-50 balance in Fed's dual mandate. Basically, back to normal. Wow. Dovish. I'm going to tweet that. Okay, tweeted that. So I don't see any other replies yet from Nick T. He's probably still parsing and coming up with questions. And so I'm just going through... let's see here. Let me see what other suits are saying. The statement could feel very dated if we get a soft jobs number on Friday. That's true. I think the Fed probably knows already what this jobs number is going to be. My take. Critics say the Fed's getting behind the curve. Quite balanced. Captures the moderation in inflation. meet our expectation. It's balanced. Blah, 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 blah. No obvious language for a September cut. Again, that should have been highly obvious, right? That should have been obvious. So I'm going to keep going with the thesis that Jerome Powell, J. Powell, have not decided on cutting in September. We're going to make that a box. So they've not decided on cutting in September. The July data will help. Oh, let's listen to Rick here for a moment. I always like his sort of bear takes.
So much larger than it was just several years ago. And why were they allowed to create such huge deficits? Because the Fed kept rates too low, too long. They can't make the mistake again of being an enabler. We still have an administration that loves to overspend. They need to keep these rates higher for longer. One rate cut won't be a big deal, but they're going to trap themselves. The market says SEP. They're right in tune with the market. I hear people say 50-50. It certainly doesn't look 50-50 to me. But what is going to be a problem?
Is he listening to me?
Set the stage after the first rate cut, because give an inch, give a up to the elbow. They're going to want the whole thing. They're going to want more rate cuts. And the Fed really needs to be cognizant of the fact that we are now potentially looking at a Minsky moment when it comes to supply, and they're at the epicenter of how we frame the equation for how much we can spend, how much we can borrow, and how much we can afford to service the debt. Tyler, back to you.
All right, Rick Santelli, thank you very much. More and more experts.
I love it. I love it. Okay, so we're going to keep going with Fed Bingo here. We've got about 16 minutes to go before Federal Reserve Bingo. In case you're just now tuning in, very important for you to recognize what happened right here in the last sentence. This is critically important. Highly encourage you pay attention to this. Right here, the last line of this says, "Today is the last day of Kevin's coupon code for the programs on building your wealth. It expires at 11:59 p.m. Email us at staff@meetkevin.com if you have questions. Buy-sell alerts are included in the Stocks and Psych group. No guarantees we can make money. I've been green for quite a bit. Today, at the moment, I'm red because I'm buying calls on this Fed meeting. And I am honestly, I'm betting on a run into the close, because partly including of this. This right here, completely removed the the inflation aspect of this statement, and instead gave us a 50-50 balanced outlook. That's pretty impressive. Now, let's finish our Fed Powell here. You're not really going to fully appreciate a move in the markets here until J. Powell's speech is over. So we'll get his speech, we'll get the Q&A, we'll get, we should write down our usual over here. We should do Nick T next to NYT Blondie. We always like that one. We like the, we'll throw another freebie over here. Purple tie. Remember, the Fed is apolitical. So then we're going to go for, let's see here. Let's see. Trying to think of some other things to say. So we want to have not decided on cutting. I would say they're going to say, have begun the discussions of easing. I think they're going to say that. They're going to say, hey, we've begun the discussions. PS market prob rallies on that statement alone. That's probably, like, the market would be okay with that. Because remember, you have Jackson Hole coming up. And at Jackson Hole, that's when they can really go forward guidance on September if they wanted to. Then we've got, someone will ask, is inflation and jobs target now an equal priority? Not declaring victory. Have not decided on cutting in September. The July data will help. Did I write data dependent somewhere? I don't think I did. I actually have a voiceover for that can help us out.
Data dependent.
Yeah. So I would really like to hear some reference. So I'm going to say that here. Or some reference to equally balanced, right? The risk. That would be very big. How about, let's go with, data dependent, bond market, let's see here, normalization could be a good one. A normalization, right? I would say there'll be, a reference to the multivariate core could be interesting. What about GDP? I bet somebody's going to ask about the SOM rule. Someone asks about SOM rule trigger. Then let's cue the audience here. What do y'all got? Pump it up, stable pricing. Powell pump it up. Kevin's courses are well worth the small investment grade information. Thank you. Thank you so much, Mike K. Yeah, AMD is on sale. This is true. This is very true. It's crazy. Nvidia is up like $100 for every $3 AMD is up. I think it's remarkable given that it was AMD's earnings that led to some of the enthusiasm. So, oh well. I mean, that's called trading. So, let's see here. Boeing was good when they replaced the, what's it called? Boeing earnings were good when they replaced the CEO. David Calhoun got the boot. Just so you know what I see from a technical basis as to why I'm looking at AMD. Look at this. I'll show you my sort of technicals. All right, ready for this? First of all, AMD went through hell. Okay, it started up at like 153. You literally had the hell downtrend, consolidated, broke consolidation, and fell to 140. In my humble opinion, not personalized advice, don't sue me, bro. If the market rallies after this and you get good meta earnings, this is a $160 stock. Not financial advice. Don't sue me, bro, but the next stop is 160. AMD being up 3% after those earnings, and it's trading for a PEG ratio of 1.2? Dude, it's probably even lower right now. It's crazy. Absolutely crazy, especially in the face of Nvidia being up 11%. I think if the market closes today and it's still like this, tomorrow people are going to be like, huh? How did AMD get left behind so much? Oh, damn. Like, I'm more bullish AMD right now than I am Tesla. Well, that's also because I'm slightly bearish Tesla. Anyway, okay, enough about the stock talk. Ubiquity, I continue to be very bullish in. I also have long positions in that. Nvidia, I'm also, because of AMD, and what we heard yesterday from Microsoft, bullish Nvidia, bullish Microsoft. Wouldn't be surprised if Microsoft rallies into the close as well. The fact that it's negative after those earnings, I'll tell you why it's negative after those earnings. Everyone in mainstream media, and I said it as well when the earnings came out, because that's what the ticker said. The ticker tape said, it's not really the ticker tape, but the tape, we'd like to call it, the news feed. The news feed said, Microsoft misses on cloud revenue. Okay, and then in their earnings call, they said, yes, we missed on non-AI cloud in Europe. We factored that into our forward guidance. By the way, we see Azure growth accelerating. And I'm like, oh, yeah, that's bullish. So I was bullish about that. But somebody here says, I own Meta. Can't wait. I actually have exposure to Meta as well. Long exposure to it. Okay, anyway, so that's my thesis here. As far as where do I think the Qs can go, 176, baby. Into the close. I don't know if we're going to get 176 into the close. You need another 1.5%. That'd be a 4% day on the Qs. It would be crazy. I don't think it's probable, but it's possible. I wouldn't be surprised to trend towards 476 by the end of the week, assuming earnings are good. You know, if you have Qualcomm poop its pants and Meta poop its pants today with earnings, you're done on calls. But anyway, okay, so that's just my thesis. Again, could all be wrong, but I am bullish on this JPOW. But I'm also going in with the realistic expectations. I was not looking for a cut, and I'm not looking for a tee up to September. And nobody should be. If they give us even a hint of a tee up to September, because the market is fully pricing that, well, that's a gift. Let me see what the market is pricing for September right now. So it should still be pretty straightforward. 1.046. So it did edge down a little bit, but you're still over a full cut priced in for September. Okay, so now what we're going to do is we got to finish this board. We've got 8 minutes to go. Finish the board, baby. What else do we got? So we got normalization, purple tie. Someone asked about the SOM rule trigger. Let's see here. Let's see. Someone asks about a soft landing would be good. Yes. Asked or comments about soft landing, or references mid-90s, right? That would be good. Unemployment. Yeah. That would be Psalm rule, or unemployment recession, right? Excuse me. Yeah, pressure. Oh, yeah. Asked about politics. I mean, it's going to be so dumb if he's asked about politics again. What we should also do is asked about Basel III. Wait. Asked about climate change or DEI. I'm putting all the funky ones over here. Wait. I'm going to move this one over then. Well, this is going to be the funky bar. The far right's going to be funky. Asked about climate change or DEI. Asked about Basel III. Asked about politics. Asked about, I don't know, what are some other stupid things that could be asked about? Let's see. I mean, geopolitics is a fair thing to be asked about. So any geopolitical risk mention or ask. Yeah, it's pretty fair. China. His bike. You get that on the interviews. Not my job. Ooh, you get that on the interviews as well. Not my job. Oh, getting replaced. Yes. Getting replaced. I like that. By Trump. Right? So that could be a double whammy right there. We'll give us credit for 2 right there if that hits. Brings out the iPad. No, he didn't like the iPad. I mean, that you know, I'll put it over here, but it's, I think that's an edge. I'll give it to you. iPad comes back. Okay, all right. Okay. What about, let's see here. So, inflation has eased. That's interesting. Acknowledge the hard work by the committee. Cold by yourself. Aliens. Wearing blue tie. That'd be an edge, huh? Affordable housing. Housing market. Yeah, some kind of weakening of the housing market, right? We can put that over here. Weakening housing market. Okay, I like it. Okay. Then return of the Mac. That's funny. Let's see here. I wish reporter would ask what Jerome Powell thinks about the Fed being abolished. Well, probably not. Asked about Kevin's courses. Talks about the debt. Yeah. Unsustainable debt. That's generally a pretty easy freebie. I want to think of some more specific ones that I think he's definitely going to hit. So, have not decided on cutting in September. Not declaring victory. July data will help. We will know more in the coming weeks. That's going to imply Jackson Hole. We will know more in coming weeks, which implies Jackson Hole or directly references it. Okay. And then, yeah, Microsoft goes green at the end of the day. Actually think there's a high likelihood of that. I do like not my job. You know what? I'm gonna put that one in. Not my job. That's one of my favorite lines. Although that's a little bit more of a congressional testimony statement. We haven't discussed the details of the next meeting. Meeting by meeting. That's gonna be an easy one. Meeting by meeting. Yeah, that's an easy crutch he uses. Not declaring victory. Have not decided on cutting rates. Did I say discussions have begun? Have begun discussions of easing. That, I think, pumps markets. Yeah, I like that. Data dependent. Yes.
Data dependent.
References PP.
Nice PP.
Pricing power. Yes. Who doesn't like pricing power?
Pricing power.
Close the effing door. Says good afternoon. Yeah. I need like 2 more boxes here. Powell reminds everyone there's an expiring coupon code. Hell yeah. Haven't discussed that. Not my job yet. Bank of Japan. The throat clear. Oh, asked to repeat a question. I like. Oh, Wololo. Wololo. Yes. We got tie color. Wait, did we? I'm pretty sure we have purple tie in here. Didn't I? I'm pretty sure I put that in here. Purple tie, top left. Okay, then we're gonna have, let's see here, geopolitical reasons. Oh, yeah. Something about the lag of housing data, rents, owners equivalent rents. That's a good one. Yeah. Inflation, therefore, coming down, right? And then maybe something on remaining sectors of high inflation, or those that typically lag, like insurances. And now that one's a little stretchy, but I'm gonna go with it because I think it's a good YOLO right there. I'm the king of YOLO and losing. But let's see what happens here. So there we go. This is our full deck here. J-Pow's up in 2 minutes. And looks like good. You got a good little climb up. I don't want to jinx it. I'm famous for jinxing this stuff. I'm also just like knocking on all the wood I can on a recovery here on AMD. Personally, I think this is so oversold for fantastic earnings. But anyway, you got a nice uptrend here. Very nice uptrend on AMD. Knock on wood that continues. You got an uptrend on the Qs that you've had for, about coming up on about 50 minutes here. NVIDIA's holding on to its 12%. Ubiquity keeps moving up. Low volume, though. Supermicro moving up. We've got Microsoft. It tried getting back to 420 there, but got rejected at 420. So it's got a little more work to do. Got Wingstop that's down. That's fine. I don't like Wingstop anyway. I got Tesla up about 4%. Pretty good. BITI. What about... Yeah, Bitcoin sitting at 66.1. A little tenuous here. Bitcoin seems to be waiting to see what happens with LJ Powell. Oh, Enphase up 4.5%. Very nice. Tesla Tequila tonight. Hey, we have a bet going in the course member live stream this morning. I said if a certain thing happens, we're getting drunk together on a custom course member live stream tonight. Let's see if it can happen. All right, is everyone ready? J-Pow is going to be out in a moment.
Yeah, I mean, this is about as good as the Doves could want for a statement. There was a lot of red ink, and I can only imagine how many hours and hours of painstaking negotiation were over every word.
We're going to have to break
Get her off.
in there, Claudia. Thank you. Jerome
Here he is
Powell
on time.
now, the chairman
Good
of the Fed.
afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Yes.
Our economy has made considerable progress toward both goals over the past 2 years.
Bullish.
The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic.
Yep,
strong,
normalization.
but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
Here we go.
The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence.
Okay.
We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices.
What?
We remain
Maintain longer. We don't want that. That's bad.
to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
And trade.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina.
Was that a laptop?
Gina Smilik from the New York Times. Thanks for taking our questions.
Where's Nick
Markets
T?
pretty much entirely expect a rate cut in September at this stage.
Oh, she's going for it.
I wonder if you think that's
Dude, she's going right for it. Here it is.
If so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes a September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be, whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Duh, because they didn't cut today.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's
Good
just
question.
a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%.
Why is this girl between Nick T and Blondie?
Inflation and already beyond what was projected for the labor market. I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits.
Bro, one more good read and we got the September cut in the bag. That's what he's saying.
The labor market, but we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Yeah, this is bullish, man. It's
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as we're actually in a good place here. We're balancing these two risks of go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Coupon code expiring soon.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now of thinking that rates need to be normalized here? Thank you.
Good question.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data, and things like the ECI report, and frankly the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy.
End phase is going straight up, baby.
It looks like an economy that's normalizing.
And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question, the time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today.
That means some wanted today.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions.
When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, I mean, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Pretty bullish.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
I freaking knew it!
So I would just say the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. It starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself; it rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be: is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown of the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Mayor.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are a lot of. It's just difficult to do. So I look at both. But I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table,
there it is.
It would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings, and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary, but we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win.
Thank you.
We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. we're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Good.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September?
Yes.
Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
This is going great.
Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Fine. He didn't say no.
Of course, they haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
He already has.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Assuming that the totality of the data supports such an outcome, no question. That is the case. That as I mentioned,
tee up, baby, tee up.
We think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Better than expected.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, We had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
This is great.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot.
Basel III.
With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all of those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
And welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York
Wow.
Stock.
Okay, I'm going to give a full summary here. Remember, today is coupon expiration day, so if you haven't checked out the courses on building your wealth with, check them out over at meetkevin.com. We've also got the Mastermind at meetkevin.com/mastermind. First meeting is almost full, so if you want to join us at the first Mastermind, make sure you check it out over at meetkevin.com/mastermind for that. All right, let's get into the full summary. Wow, this was something. All right, here we go. So, yeah, that did sort of end abruptly. You're right. All right, here we go. Well, there we have it. The Federal Reserve catalyst is out of the way, and I have to say, some things went as expected, some things did not go as expected here. First of all, we know we are coming off of good earnings for AMD and Microsoft. Fantastic earnings here. And NVIDIA is benefiting way more than AMD or Microsoft are benefiting. But what did the Federal Reserve just say? Well, the Fed told us the time has come. Now, that's the time for rate cuts. Now, this is mind-blowing to me that they actually teed this up. They totally teed up the September rate cut. I was not expecting that. I was expecting a neutral to positive or neutral to dovish Fed. We got dovish and positive and teed up rate cut, baby. Now, let's explain how they teed this up because it was pretty remarkable. First, they started with the statement. The statement started off pretty obvious that we were about to have a dovish Fed because they were completely removed the idea that they were going to be highly attentive to inflation risks, and we were really surprised when we saw this. Instead, they moved to this sort of 50-50 aspect where they're attentive to both sides of the dual mandate, which basically implies they're equally balanced between, we're bullish on jobs and bullish on inflation. They've equally balanced this now. Now, of course, they're not going to declare victory, but wow, what did they tell us in the meeting? They told us that inflation has eased substantially. We're attentive to both sides. We've got good growth, 2.6%. Investment in equipment has picked back up. Inflation has eased notably, and we've made considerable progress on inflation. This was mentioned maybe 3 or 4 times. So really trying to show that they wanted to bring this idea that they're so heavily focused on inflation down into balance. And later in the meeting, he even said, we're pretty much balanced now between the two. We're moving closer to where it will be appropriate to reduce policy rates. He went into even more detail later. Rate cuts could be on the table as soon as the next meeting, and we are getting closer to the point of where we can reduce rates. He says if we get a disappointing reading, obviously that could weigh against a September meeting cut. We want more good data. We've seen progress. What I'm basically gathering from this is as long as you have an acceptable jobs report and an acceptable CPI report, they will clearly signal by Jackson Hole, the 3rd week of October, that yes, the rate cut for September is in the bag. The progress is equal now. Keep in mind, when I get through the summary, I'm also going to go through my thoughts on the market and trades and things like that, so we'll cover that. Just want to get through some of what Jay Powell just said. And then, of course, remember, today is coupon expiration day. Questions, email staff@meetkevin.com. Otherwise, get in before the price goes up. You get lifetime access. So even if I'm right yesterday and wrong today or whatever it is, you get me for life in the course member live stream, and you get my ideas, and you get my perspectives. So if you like my perspectives, consider checking that out at meetkevin.com. Or if you want something more detailed, go to the meetkevin.com/mastermind. The next group is almost full for October. All right, we last raised rates a year ago in the July meeting. Today, we're in a completely different economy. He says we've made a lot of progress. We've made progress on all 3 forms of inflation, all 3 core forms of inflation. Goods, non-housing services, and housing services. We can afford to begin adjusting rates. The upside risk to inflation has decreased. The time is coming at which it is beginning to become appropriate to cut back those restrictions. Headline number on jobs have come down, and the majority supported not moving today. Now, this is really interesting because it somewhat implies that some were for actually cutting today. Or maybe hiking, but I doubt hiking. It was probably someone was like, oh, why don't we cut today? And everyone's like, nah, let's consensus cut in September. He says, we're starting to see the lags start showing up, the lagging effects of higher rates on the economy start showing up. He says that the labor market has seen a normalization. Was asked about the SOM rule. We actually specifically thought that he would get asked about it. We wrote this on our Fed Bingo. Someone asks about the SOM rule trigger. Literally got asked about it. But I'll tell you, look at how I lost Bingo here. I had 2 chances at Bingo. I had a shot at Bingo across the board right here on the second row. This was a shot at Bingo, and this was a shot at Bingo. But I literally lost Bingo in 2 ways because Nick T did not sit next to the New York Times Blondie. I'm like, what the hell? Like, seriously, he always sits next to Jenna from the New York Times. This is the first time in years Nick T had a different woman between him and her. What is this? This is crazy. Anyway, so that was a little bit of a disappointment because I would have had double Bingo. But anyway, Jerome Powell suggests this situation is unique. No decision made yet on whether we'll do a 25 BP cut or 50, that we are consensus driven. As soon as the next meeting, he was asked, would you consider cutting as soon as the next meeting? Is there a growing consensus? And he said, yes, there is a growing consensus. The time is rapidly approaching to cut, as long as the data doesn't show a sharp weakening. So, in my opinion now, here's how trades get played. And this is tough, okay? This is tough to play. So I want to make this crystal clear. So we're going to set this up on screen here. This is my take for the trades, okay? So last week, we said whatever earnings are, they drive the market this week. Fed will introduce vol, but that's it. Maybe short-term trade, but earnings will prevail. So, what are we seeing? Well, we saw markets rally after AMD and Microsoft yesterday. What do we expect today? Markets right now are trading down going into the close. Why? My opinion, markets are waiting for QCOM, Meta, and ARM. And then tomorrow, we get Apple and Amazon tomorrow. So in other words, true bullishness may not fully unlock until we clear all of these earnings. So, a lot of people are saying, Kevin, in your opinion, not financial advice, when is it time to buy the dip? When dip buy? I think there's an argument to say you dip buy potentially each of the good earnings, right? Maybe each good earnings set. So a little today based on AMD MSFT. A little tomorrow based on ARM, QCOM, Meta today if the earnings are good. And then a little Thursday / Friday based on Apple, Amazon if the earnings are good, right? Now, remember what I've said since last week. I said, if earnings bad, recession. If earnings good, flip bullish, right? And then I also said, Fed will just add fuel to the fire of whatever earnings are. I maintain this belief. Now, so far, we are trending in the bullish direction. So I think the markets, as long as we continue to get good earnings, will trend bullish in through the week. Everything. IWM, the Qs, chips, interest rate sensitives. I don't really care what it is. I think it all goes up into Friday as long as ARM, QCOM, Meta, Amazon, and Apple don't get reamed. If they get reamed, you got big problems. So that's my take. So that's why I think if you're looking for sort of longer term dip buys, maybe every time you get good earnings, you dip buy. Another option is, other option, wait until earnings are done. And then another thing you could do if you want less volatility, so for less vol in a trading portfolio, I'd probably go at least next Friday, unless you have diamond balls or, some like, death wish or whatever. Not saying I don't. I do crazy things sometimes. But anyway, probably a good idea because there will be volatility. And really that volatility is going to be based off of earnings. Now, markets were really tenuous going into the Fed meeting today. I think that's because markets are like, what if we get rugged? What if we get rugged? Didn't expect a rug, didn't get rugged, but I also didn't expect them to tee up the September rate cut the way they did. And frankly, they fully gave us an all clear for a Fed rate cut in September. So now I'm going to take a brief look just to see at where yields sit right now and the odds of a September rate cut. September rate cut odds just jumped. We're now at 1.16. After the FOMC, or at the beginning of J. Powell talking, we were only at about 1.04 rate cuts. That's now jumped to 1.16. We're now at almost pricing in 2 full rate cuts by November, and almost pricing in 3 full by December, and then 3.5 for January. So we'll see where markets go, but I think there's going to be a lot of tenuousness on these earnings. If we could get these earnings out of the way, finally, we could have the all clear, and we could get rid of all hedges. It's my take. Still got some hedges, and as we continue to get good earnings, I'm going to roll off those hedges. So let's see what happens. Anyway, if you want to know exactly what I'm doing, make sure you're part of this Stocks and Psych group linked down below. Can't guarantee you'll make money, but always guarantee to provide you the best perspective that I possibly can give. And folks, today is coupon expiration day. That does mean the price goes up at the end of the day today, 11:59 p.m. today. You got questions, email us at staff@meetkevin.com. Jeffrey Gunlock says, a lot of room for the Fed to cut short-term rates in an interview on CNBC. Yeah, no kidding. Oh, yeah, he's yapping right now on CNBC. Anyway, we're going to be jumping over to the market, closing live stream for Meta earnings within about 30 minutes. We'll see you all soon. Thank you so very much for being here, and we'll see you. Goodbye, and good luck. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. There you have it. Thanks so much for being here. See y'all soon. Bye.